What does price to earnings ratio mean in stocks? It's a super common metrics. It's one of those in the fact box below the stock chart. If you Google, for example, Palantir stock or something like this, together with dividend yield and some other common indicators. That's why I decided to make a stand-alone video talking about the price to earnings ratio. Funnily enough, it's also one of the things that the investment banks asked me about in interviews in the past. And how would you pitch this stock to a customer using and then some metrics? So it's an important metric, it's commonly used, and it can be valuable in trying to interpret what a stock should be trading at and what's driving stock price. The formula is quite simple. The P stands for price, the E stands for earning. You just take the price of a single stock and you divide it with the earnings per share, and then you get the price to earnings ratio. What does this ratio actually tell us about the company? Well, it tells us how many years with the current rate of earnings we need to recuperate our full investment. So let's say you have a lemonade stand making $1 every year. A share, the whole lemonade stand in this case cost $10. So you put in $10, you get $1 back every year, nothing changes. You're gonna have a price to earnings ratio of 10. 10 years to recuperate your investment by this lemonade business. But the world out there is not as static as this example, and we will see wide variations and swings. For example, in the case of Tesla, they had a astronomical price to earnings ratio of 6,000 something in the beginning when they had just turned profitable. I remember following up, and indeed they delivered on a promise of growth and was able to grow this earnings to eventually get price to earnings come down. But that differs the question, why was price to earnings so high for Tesla in this case? And it's not a super simple answer, but the easiest way to explain it would be that Tesla in this case promised a high growth rate, so revenue was growing quickly, and this would affect profits, and this made investors bake into their financial models of valuation that they were seeing, revenue is growing so fast, so in the future earnings is going to grow a lot faster too. So that's why we can pay an expensive price today, because in the future the company will continue to grow these earnings so quickly, so it will all make sense and we will basically make a ton of money from this. So we factor in growth rate. If the company is growing quickly in revenue, in general, you will see higher price to earnings ratios in this case. And if it's a stable company like AT&T or some mobile telecommunications provider like that, some real staple of industry with slow growth rate, well, then you're gonna see a lower price to earnings ratio, just slightly above 10 in most cases like that, with slow or no growth. We've seen some good cases with 8 and 9 as well in some stocks in this channel that we analyzed together. However, that explains the price to earnings ratio for stocks more in detail. We factor in growth as well. And when it comes to the real interesting stocks that I like to cover on this channel and that you guys like to comment below for me to take a look at, we see these companies who are not yet profitable, and in this case they will not even have a price to earnings ratio that we can look at, and we have to try to understand the business, try to understand the macroeconomic market and see, alright, when is it reasonable for this company to become profitable? When can they start to grow earnings? And is revenue growing, declining? And we need to make assumptions in the future. And with those high levels of uncertainty and risk, then it's also a large opportunity to make a ton of money as an investor. So that's why I like to look at some companies that don't have a price to earnings ratio yet, but with quick revenue growth, and especially when they are close to flipping profitable, because once they flip profitable, we see that this earning is giving them the actual price to earnings ratio, and the analysts on Wall Street will have an easier time analyzing, understanding the stocks. And then we see this institutional buy-in that drives up the price of the stock. So it's like a twin engine to a rocket ship taking off, as some famous investor called Peter Lynch would have explained it. He talks about it in his book One Up on Wall Street. Excellent read that I can highly recommend. Anyways, that's been it for this video, talking about what PE in stock means. I guess it's a interesting feature since it's showcased in the fact box there in Google, and I'm happy to answer any questions you might have about this ratio down in the comments below. Alright, that's been it for this video, and as always, hope you guys make a ton of money, whatever investments you decide to make. Take care now. Bye bye.